Welcome to class number 11, gang. I'd like to take a moment and reflect on what we've accomplished in our first 10 classes together. First, we learned how to do a high-level overview of our finances with our personal balance sheet and our personal income statement. Then, we did a deep dive into managing our cash and our debt. Our next big topic is investing. Investing is a subject that can be very confusing to folks without a background in finance. It's also one of the most misunderstood areas and often leaves people filled with anxiety. We're going to break investing down to its basics in a way that's clear, honest, and empowering. Before we jump into the world of stocks, bonds, real estate, etc., we first need to build up our financial knowledge with a few key concepts. We'll cover the first two of these concepts in this class, and they are the time value of money and the risk-reward, also called the risk-return relationship. Let's begin with the time value of money. If I were to give you a choice of receiving $10,000 today or $10,000 in 3 months, which would you choose? Well, as you can probably guess, most would rather have the money today. In almost all cases, that's the right choice. But why? In finance, we call this preference the time value of money. That is, money received today normally has greater value than the same amount received in the future. One of the primary reasons why people prefer money today as opposed to sometime in the future is because they can use this money to earn even more money over time through saving, lending, or investing it. I like using an example to show this. Let's assume two people named Harry and Marv are given the option of receiving $10,000 today or $10,000 in 3 months. Harry knows the time value of money and chooses to receive the $10,000 today, while Marv slept through his financial skills class and thinks it might be better to have the $10,000 in 3 months. Harry receives the $10,000 today and decides to buy a 3-month United States Treasury bill or 3-month T-bill through his broker that will pay him 5% annual interest or 1.25% over the 3 months. Fast forward 3 months and Harry will have earned interest on his investment, while Marv will still only get $10,000. Are you wondering what the heck a United States Treasury bill or a broker is? We'll cover these in detail later, but for now, just know that the U.S. Treasury bill is essentially the U.S. government borrowing money, and a broker is just a company where individuals can buy investments. In our last few classes, we taught debt using individuals as the borrower. That is, debt we owe to a lender. In the case of a debt investment like a treasury bill, the relationship is flipped, and Harry essentially lent money to the U.S. government for a period of 3 months and received interest to compensate him. A debt investment is a type of asset if we own it. Since Harry took the money today, he was able to invest it in a bond and receive interest, while Marv couldn't do anything because he chose to wait 3 months to get his money. This is the time value of money at work. Concept number 1, check. Now, let's learn about the risk-reward relationship, which is also called the risk-return relationship. Again, we'll use the Harry and Marv example as our guide. But before we get back to the example, let's set the groundwork with a definition. What is risk? Risk is simply the potential for something bad to happen. In terms of an investment like debt, it's the risk that you don't receive your investment back and also don't receive the benefits you expect to receive for making the investment. To compensate an investor for buying an investment with higher risk, they seek to receive a higher return or reward. Therefore, one of the key concepts underlying all of investing is that investments with low risk should provide low returns. Investments with medium risk should provide medium returns, and investments with high risk should provide high returns. In other words, risk and returns are usually positively correlated. As we'll see in future lessons, investment risk can't be eliminated, but it can be managed. There are all types of risks that investors need to think about when buying an investment. For this lesson, we're going to keep things pretty basic and talk about two types of risk that affect debt investments as an example. These two risks are called credit risk and interest rate or maturity risk. Credit risk is simply the risk that the borrower, in this case the U.S. government, doesn't repay their debt and interest as agreed. Interest rate or maturity risk is the risk that interest rates change during the term of the debt agreement, and the lender isn't able to earn a higher rate the market is offering because the interest on the debt is based on a fixed rate. Imagine if I lend you money for a period of 30 years at a fixed interest rate. If interest rates rise significantly over the next year, I can't receive those higher rates because that money is locked up with you for 29 more years at the original fixed interest rate. Let's get back to Harry and Marv. In the example we discussed a few minutes ago, we demonstrated the time value of money with basically no risk through Harry's investment in a 3-month U.S. Treasury bill, no credit risk and no interest rate risk. Why no credit risk? Well, the U.S. government is considered to be the most secure borrower since it can print more money to pay off previous debts and is backed by the largest economy in the world. Also, U.S. Treasury debt is backed by the full faith and credit of the U.S. government. We'll talk more about this later, but for now, just think of the U.S. government as a borrower with essentially no credit risk. Why no interest rate risk? Well, 3 months is considered to be a very, very short period of time compared to other terms of debt like 10 years or 30 years. As such, there is a very, very small chance that interest rates will significantly change during that 3-month period. Since it's very, very small, to make things easier, we'll just say that any type of debt with a 3-month maturity has no interest rate risk. Since a 3-month U.S. Treasury bill is considered to have virtually no risk, the interest rate that is offered on the investment is called the risk-free rate. The risk-free rate is determined by various factors and changes regularly. We'll discuss this more later. Now, let's consider an interesting question. What if Harry wanted a debt investment, but he wanted to earn a higher rate than a risk-free 3-month Treasury bill offers? First, he can lock in his investment for a longer period of time, like by buying a 30-year fixed interest rate U.S. Treasury bond. In most cases, he should expect a higher return or yield because he's locking in his investment at a fixed rate for a much longer period of time than 3 months. That is, he's taking on much higher interest rate risk by locking in his rate for 30 years. To compensate him for this higher risk, Harry would usually get a higher return. In this case, we'll assume that the 30-year Treasury bond pays 7% interest a year versus the 5% annual rate he got on the 3-month Treasury debt investment. If we want to see the current Treasury rates offered on fixed rate Treasury debt from 3 months all the way up to 30 years, we can create something called the U.S. Treasury yield curve or graph. In normal times, the yield should be higher for longer terms of debt, all else equal. However, on very rare occasions, financial markets do things that don't follow this logic, and this is one area you might see something odd. When shorter term rates are higher than longer term rates, all else equal, you have something called an inverted yield curve. We'll discuss this more later, but for now, that's all I'm going to say about that. Okay, so we know if Harry wants a higher return, he can lock in his money longer by taking on more interest rate risk. What other options does he have? Well, Harry can also get a higher return by buying a riskier debt investment. Let's say instead of lending to the US government, Harry decided to lend to a large tool company called Crowbars Up Incorporated. Large corporations borrow money just like individuals or the government do. One way they borrow money is by issuing corporate bonds. In this case, let's say Harry bought 30-year corporate bonds from Crowbars Up Inc., paying 12% interest. Corporations don't have a money printing machine like the government does, and aren't usually rescued when they fall on hard times. If Crowbars Up Inc. ends up in bankruptcy, Harry could lose some or all of his investment and future interest. In other words, Crowbars Up has credit risk on its debt. To compensate Harry for this risk, the company is willing to pay him 12% a year in interest for 30 years versus the 7% that the government would give him for a bond with the same term. To recap our example, the 3-month Treasury has no risk and pays a 5% annual rate. This 5% rate is the risk-free rate. The 30-year Treasury has 30 years of interest rate risk and pays a 7% annual rate. That is, it pays a 2% risk premium for interest rate risk. Finally, the 30-year corporate bond for Crowbars Up Inc. has credit risk and is paying a 12% annual rate. The 12% rate tells us that Crowbars Up is essentially paying Harry an additional 5% for the additional credit risk, also called the credit risk premium. Credit risk varies based on many factors and is entity specific. That is, each company has its own credit risk, and that risk will change over time. We'll talk more about how to assess this risk later. Congratulations! You just learned 2 very important financial concepts that will help you out big time when we get into our lessons on investing. Also, I realize that's a lot of information at once for someone with no background in investing. I can't stress this enough, but it's so important to take your time and really understand what's discussed here. If you need to watch this lesson a few times for it to click, go for it. Don't get too bogged down by the details. The key is to have a high-level understanding. There's so much to cover in the investing world, and it's going to feel a bit challenging until you get through more of the unit. But I'm confident it will all be pieced together in your mind once we are done. I have great news for you. No homework for this lesson, except watch this video again if you think you need to. We'll continue with more key concepts in our next class. Stay tuned. If you have any questions at all, please contact me at opusmonitequestions@gmail.com or comment below, and I will try my best to get back to you as soon as I can. Thanks for watching. We rely heavily on recommendations. Please follow us on Instagram, subscribe to us, and like this video on YouTube, and share our program with your friends and family. See you all in class number 12. Peace!